Also bring on board Mayuresh Joshi, Fund Manager with Angel Broking. Mayuresh, good morning. Thank you for joining us. Axis Bank, another quarter of disappointment. I mean, now it's clear that beneath, beneath calm waters, there is a lot of NPA problem even for private banks.
Morning, Nikunj. I think clearly if one goes by the numbers, the NIMs and the NI growth a tad bit better than what we had probably estimated. Yes, I think asset quality pressures were expected to continue for a lot of these larger private sector banks who probably got exposure to the corporate houses. So clearly I think if one goes by the management hearsay of cleaning up probably having been done, I think the stress in the system still sustains. So clearly I think we are expecting the next quarter to be a little bit muted as well, not just for Axis Bank but banks generally having exposure towards the corporate sector as a whole. So having said that, probably I think with credit costs expected to go up, our own take is that the earnings might take a hit from an FY17 perspective. So we've already trimmed down our estimates for FY17. Though again, I think valuations remain supportive and we remain optimistic, assuming that if the credit growth resumes over the next few months at a pace much faster than what the industry probably expects, our take is that the larger private sector banks will rebound in a much better fashion. So clearly I think earnings estimates are being taken a hit over the next few quarters. The asset quality will remain soft to say the least for the next quarter, and clearly that will have a telling effect on how the stock might behave. But clearly I think any decline onto the stock becomes a good opportunity, but one needs to buy in small quantities and probably a large section of the larger private sector banks in chunks rather than just concentrating on one bank.
Right. Mayuresh, so what's the way forward now for private banks? Asset quality concerns are visible. These are over-owned banks now. I mean, what is the way forward?
No, clearly, as I mentioned earlier, Nikunj, I think the banks having more of a retail exposure and where corporates with ratings of AA, AAA, I think those are the banks that might do well even in this environment. So something like an HDFC Bank, in our opinion, will keep on posting robust set of numbers. Secondly, I think even if you look at the trajectory that a lot of these other banks, including Axis Bank, is probably doing, I think the exposure on the infrastructure side, though it accounts for almost 47-48% of its total advances, the new sanctions that are probably happening to AAA corporate rated borrowers. So clearly I think we're probably seeing some amount of shift happening on that front, but at least I think the expected asset quality pressures might start receding down. On these larger private sector banks which have just mushroomed and where the CASA ratios are probably coming up, something like an Yes Bank for example, I think the CASA ratio is picking up, but clearly I think even the stress there might be a little bit evident at least for the next 2 quarters with the RBI directive coming through. But clearly I think if you pick and choose out of these 4 or 5, I think the stress might be evident as I've been mentioning time and again. But clearly I think it de-risks your portfolio by just putting your money in one stock. So I think Axis, Yes, ICICI, HDFC Bank, I think these are the banks that we'll probably still be comfortable with over a 2-year time horizon.
Okay. Let's get in some more trading ideas from our experts as well. Also give the CK Narayan's positional trade. Sandeep, to you first. What are the trading ideas that you have for our viewers?
Neeraj, just sell in a UPL, stop loss 385. UPL has broken a very strong support at 390, 385, somewhere between that. And I would be a seller on any bounce back that comes in with a stop loss of 385, target of 348. And a buy in a JSW Steel, which was also my VTST idea yesterday. I see some more momentum, or 4-5% trading upside is what I would play for. Buy it with a stop loss of 997, target of 1071.
CK Narayan, what is the positional call for the day?
Well, for a positional play, I'm looking at Havells, and the main reason for picking Havells is that its price behavior has been a little different across the list of the let's say the larger mid caps to the within the future space. It actually had a bottom on the 14 compared to many of the other stocks which have actually drowned over the last 2-3 sessions and have hit successive lows. Now that itself is indicative of some differential activity which is going on in the stock. Further, we are seeing OI positions getting shared in the stock as the market weakened. So my expectation is that since it had been into a bit of a decline prior to that, the short positions have been unwound. the stock has been able to withstand the declining pressure of the last several days, which was quite sharp, and that indicates that better buyers, stronger buyers have got into the stock, and possibly when the market turns around, it is one of the stocks which should probably lead from the front. So 315.20 is the minimum that we can look at. Currently the stock is at about 288. I would say in the region of about 282 to 288 buy the stock, keep a stop at about 274 and look for a target at about 320. This is a multi-day trade and not a day trade.
Mayuresh, where are you confident about initiating a buy? Which are two or three mid-cap names which are now back in the value zone?
So clearly, Nikunj, I think if one really goes by the sharp correction that we've probably seen in the markets and expectations of earnings revival happening through the mid-cap cycle, what we've probably seen in terms of the correction witnessed in Bajaj Electricals, our own take is that a lot of the legacy orders are probably out of the system for the company. And if you're probably looking at consumer durables doing exceedingly well over the next 2 years, our own take is that the kind of expectations that one really has in terms of how the bottom line performance might be, with expansion of margins taking place over the next couple of years, it is sweetly placed in terms of both valuations and earnings upgrades. Clearly, I think in terms of the other mid-caps, I think United Phosphorus is something that will continue to like on declines. Our own take is that with the global generic market going off patent to the tune of around $3 to $4 billion over the next few years, it is clearly better placed compared to its counterparts. And again, I think if you look at the top 6 innovators, I think you are probably looking at the generic market growing at a much faster pace than what the innovation market is probably growing at. So clearly, UPL has all the benefits with existence of plants across the globe. You're probably looking at a backward integrated facilities happening, which obviously has cost attached to it. But again, I think the cost optimization probably is much better compared to the other players. And again, in terms of top line and bottom line growth, we're expecting a 15 to 20% growth over the next 2 years. Again, I think from the auto ang space, Gabriel India on declines is something that we'll prefer. Clearly, I think if you look at the business mix, two-wheelers account for a major chunk at this point of time, close to 51% of the revenues, but it's evenly spread out as well. So I think the PV segment accounts for 27%. You've got the MHCV segment, the CV segment probably accounting for 13%, and the three-wheelers 9%. Now clearly the focus has been on increasing the aftermarket share from 13 to 15 to 16% over the next couple of years. It's almost a debt-free company. You're probably looking at a decent earnings growth happening. With commodity prices coming down, you're looking at margin expansion. The first half of FY16 compared on a year-on-year comparison has seen better performance. Our own take is that 10% earnings growth over the next 2 years. You're probably looking at bottom line growth. It is foraying into the four-wheeler market with new clients like a Ford, the new platforms that M&M is getting. That will have a revival on the PV segment as well, and valuation is not too expensive at this juncture as well.
Okay, some more stocks. So if you look at what different stocks have done yesterday, so Sun TV, for example, don't look at the delivery percentages, quite frankly, on these stocks, but if you just look at the data on Sun TV, it was the biggest loser on the Nifty Midcap Index, down about 7.5% yesterday. Volumes were almost 3 times the normal 5-day or the 10-day averages. YTD, it's lost 20%, and the F&O build-up was extremely strong on this one, even though it saw a little bit of a recovery towards close. There is a bounce in the markets today, CK Narayan. Sun TV was looking extremely wobbly yesterday. What do you do, assuming that it starts flat? What do you do in terms of trades on Sun TV?
Well, I think when Sun TV dropped down to somewhere around 325, 27 yesterday, it actually banged down into support in technical terms. And lots of stock get into support zones, but then not too many stocks saw the kind of reversal from that support zone like Sun did, because it spurted from about 327 to 349 in a matter of minutes, clearly indicating that some big buying had actually come in. Now the key thing would be to see whether it sustains today. So I would think if it remains above about 335 or thereabout, I think the buyers have come back into that stock, and then it might again qualify for a buy. Maybe we can look at about 360 where there are lots of resistances, whether that is getting exceeded, then take a fresh view on that post some exhibition of strength.
I want to establish some data points, and right now I just want to again go back to that value aspect, that how cheap large cap stocks have become. And Mayuresh, you may want to be here because once I point out the data points, I'll come back to you. So L&T, State Bank of India, the carnage is just so strong in mid cap stocks that some of these mid cap stocks are now available at valuation levels which they were available in 2013. 2013 was one of the worst year for Indian economy to get derated. And if you bought stocks in 2013, you pretty much have bought an L&T at 16 times, and State Bank of India at about 1.2 times, and Axis Bank about sub 2 times. Mayuresh, come in on L&T. That's one stock where in general expectations were very high. Now that business has got completely rebooted because of concerns because of oil concerns.
Oh yes, clearly, Nikunj. And again, if you look at the different business verticals, hydrocarbons held out in the past quarter. But again, with the fall in oil prices, one really does not assume that the hydrocarbons division will bounce back, at least from a short-term perspective. Having said that, probably I think the other two business segments, heavy engineering and the metallurgical and the material handling segment, have not done too well even on the EBIT front. So clearly, I think what stands out for L&T among all this carnage is probably the strong order book that it possesses. 2,44,000 odd crores, which gives it decent revenue visibility. Yes, concerns would be there with falling oil prices, what happens on that front and how the orders might flow through, at what margins these orders might flow through. But clearly, I think the management is cognizant of that fact, and they've clearly downgraded their guidance, both in terms of order flows as well as the revenue guidance. What we've done at our end, again, I think with the management guidance coming down, that we've trimmed down our estimates as well from an FY17 perspective, with 5% on top line degrowth and 6% on the bottom line degrowth. But clearly, I think the valuations remain extremely supportive. And though we might argue on when the capex cycle will start, when the private investments will start coming through, and if one really assumes that it's taken another at least 2 to 3 quarters, even if it happens after that time period, and one really has a time horizon of 2 years, L&T is well poised on its standalone business to ride this capex cycle in a much better fashion. Secondly, I think if you look at the non-core business of L&T Infotech, it's been doing exceedingly well considering the balance sheet size. If you look at L&T real estate, I think you're probably looking at some divestments probably coming through. And even on an SOTP valuation, I think it is clearly getting valued at a discount at the current market price. So I think any decline again onto this stock becomes a good opportunity. I'm not saying that the results will be great for this quarter or the next, but clearly I think this is one stock, if you've got a long-term horizon, long-term investors should be owning this.
Fair call. That's essentially the view on Larsen & Toubro, and I think some of the others. We were talking about the valuation metrics for some of the other PSU banks or other companies as well, the large caps which have fallen and taken it on the chin the last few days. The L&Ts, the Adani Ports and the BHELs of the world are one. Then look at the SBIs, PNBs and the Axis banks. Those two have come off quite rapidly in the last few months, if you will. So Mayuresh, if you were to take one large cap bet, 30-second answer, one large cap bet, which one would that be?
Well, clearly, out of all the large caps that are probably looking attractive at this point of time, my take is that State Bank has got battered down very badly. So clearly, I think if you look at the balance sheet size, if you look at the CASA ratio, if you look at the expectations of earnings growth, yes, I think asset quality has held up. But clearly, I think valuations have become extremely attractive at this point of time. So I think State Bank is something that I probably prefer over a 2-year time horizon, where our belief is that asset quality pressures would slowly start receding down, and State Bank probably is better placed in that entire PSU run.
Okay. Mayuresh, stay on, so much more to speak about. We just getting ready for the pre-open rates to come in. Bring up the SGX Nifty for our viewers, and that is indicating some upsides. Don't know if that will last or no, but a brief respite after carnage that we saw yesterday. The global cues are also indicating some upticks, though these could be deceptive. Among stocks, Axis Bank could be interesting. It's already taken a lot on the chin. The results have been slightly more muted than what we were working with. Let's see what's the kind of reaction there. Reliance came out with good numbers. Rallied already came off. Axis Bank has gotten beaten down. Not the best of numbers. Let's see if there's a rally because of the markets as well in that one. That aside, Indiabulls Housing Finance, Reliance Infrastructure, a couple of stocks in news as well on results, and a few mid caps and small caps which will stand out. This is Indiabulls Housing Finance, of course, and then Reliance Infra will be the other interesting one in trade. But the pre-open rates come in, and we have, well, some green on the screen after a really long time, though pre-open is too early to say, but I'm sure we'll start off in the green. 7311, actually the Nifty is a lot more muted than what it should have been. The Sensex 2 now picking up steam, 1/3%, 75 odd points. So good going in the first one tick itself. What could be leading? Bring up Axis Bank firstly. That's the big stock in news after the numbers. It's difficult to say how it will open because the results haven't been the best, but because it's gone down so much, maybe the market mood today as well, early morning, could lift Axis Bank ever so slightly. So 389 for that one. Bring up Reliance Industries, had a big crack in trade yesterday after the numbers, was down 4.5%, and no, I don't think there'll be a 9% cut. I think we'll give these rates a skip. Just bring up a couple of specific names and see the likes of SBI, etc. They are flattish in trade. Maybe a Reliance Infra, maybe an Indiabulls Housing Finance. They could be pricing in what the results are showing. But otherwise, the rates are just all over the place. Let's give them a bit of a skip. Revisit them later on.
The currency and 67.84, so the stronger side of 68 is how the currency opens trade. Some respite coming in there as well. Not a whole lot. I mean, things can change in the course of the session today. But as we go across to Manisha for a quick heads up, and in fact, a quick review of the currency open. Manisha, this is pretty much playing out as far as what the equity markets are doing. Is it sustainable?
Well, that really is a big question mark, but yes, we are falling in line with what the other Asian pairs seem to be doing really. So 10 paisa on the higher side is what you've seen as a rupee opening, and this is after 0.5% decline. Yesterday we saw fresh 29-month lows coming in for the currency. We even hit an intraday low of around 68.17 in the markets yesterday, but pretty much on the higher side from those kind of levels. It's a ditto scenario when it comes to the US dollar, which is still holding above 99 but is off highs from its major peers. You have seen the US consumer prices, housing data, all of that come on the weaker side, and that seems to be putting pressure. Rupee, of course, would continue to follow what the Asian peers, equity markets, and the US dollar, especially what the Chinese yuan continues to do. And make no mistake that the rupee will continue to follow whatever Chinese yuan does, and we have seen a decline coming in for the currency in line with what the Chinese currency really seems to be doing. Well, the bond markets in the meanwhile did see some firmness coming in. You are expected to see that continuing for the day today as well. The RBI bought nearly 10,000 crore worth of G-Secs in the markets yesterday. There is more liquidity expected from RBI OMO auctions continuing, and the markets are anticipating a bond range between 7.62 to 7.72% continuing for the day today as well.
Thanks a lot for that, Manisha. So that's essentially the verdict on the currency. Mayuresh, quickly before we thank you, a word on IT as well. Mid-cap IT is actually disappointed this quarter around. None of them have actually stood up and gave a good set of numbers. So there has been a bit of a cut in all of those stocks as well. If you were to buy IT, what would you buy? Any of the large caps, or would you veer towards the mid caps again?
No, Neeraj, clearly I think the mid-cap IT performance has been quite stupendous, but clearly I think large-cap IT's valuations compared to a few of the mid-caps that have actually moved up is quite lucrative at this point of time. Now, if you stack up the top-tier companies which have come out with their performances, Infosys came out with an exceptional performance in our opinion, and if you go by the management commentary, one really expects the premium justifications to start growing up for Infosys compared to a TCS. But clearly I think Infosys is something that we continue to prefer. HCL Tech came out with a very decent set of numbers in our opinion, and in our own terms I think the expectations of both a dollar and a rupee guidance, I think 13% is not ruled out on a CAGR basis over the next 2 years. Valuations looking extremely attractive for HCL Tech as well. So I think top tier IT companies is something that I'm very, very comfortable with. Yes, I think the next quarter will determine how client spends are panning out. But clearly over the next 4 to 6 quarters, our own take is that constant currency growth should be quite reasonable. You're going to see probably expansion in utilization levels across specific companies. You're probably going to see EBIT margins probably sustain at the levels that you've probably seen and improve thereafter. So clearly Infosys, HCL Tech, TCS is something that we'll continue to prefer over the next 12 to 18 months.
Thanks, Mayuresh. Thanks so much for joining in today and giving us that perspective. Now some very interesting data on corrections that have happened